Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Yield curve, a line that becomes famous only when it starts misbehaving. Sanctions, economic pressure dressed up as diplomacy. Strategic reserves, stockpiles created for emergencies and used during headlines. Commodity supercycle, a long period when prices rise high enough to justify every bad decision. Energy security, the realization that geography matters more than ideology.
What was once a smooth hiring highway now looks like a pothole festival. The US labor market isn't just cooling, it's zigzagging. Big payroll gains one month, contractions the next. That's not a trend, that's turbulence. Two possibilities: either the economy is genuinely losing balance or the data itself is playing tricks. Seasonal quirks, revisions, or measurement noise. Markets, of course, hate both. For the Fed, this is a headache. Volatility muddies the signal. Are we slowing or just misreading the dashboard? Here's the paradox. Earnings expectations are climbing while the market is heading south. 2026 EPS is up 4%, powered largely by the Magnificent 7 optimism machine, but prices, they're compressing. Translation, this is not about profits, it's about faith. Multiples are shrinking as investors question whether those big tech dreams can actually deliver. One wobble in capex or revenue and the whole narrative gets stress tested. Markets aren't pricing earnings, they're pricing belief in those earnings. And right now, belief is looking a little leveraged. For all the talk of diversification, the Gulf's economy still runs on hydrocarbons, with some countries practically inhaling it. Kuwait near 50%, Oman pushing 50%. This isn't diversification, it's rebranding. Yes, skylines have changed, but beneath the glass and steel, the engine is still oil. It means when crude spikes or geopolitics, growth, revenues, and even stability move. The real story is better dressed while dependent. Before the missiles flew, the Gulf was exporting something even more powerful than oil: capital. Trillions parked in sovereign wealth funds, quietly buying stakes in everything from Wall Street to Silicon Valley. The UAE alone controls close to $2 to $3 trillion across its funds, with giants like ADII sitting near the $1 trillion mark. And across the region, total sovereign wealth runs north of $5 trillion, basically a global liquidity backstop. So when geopolitics heats up, it's not just oil flows at risk, it's capital flows. Investment pace slows, priorities shift, and suddenly the world's biggest patient investors get a little less patient. Demand is explosive. 150 million ticket requests for just 6.7 million seats. That's not a queue, that's a lottery with emotions attached. But here's the real game: pricing power. Final tickets jumping to nearly $11,000, fan costs quadrupling to $40,000 plus, and matchday revenues expected to triple. This isn't just a sport anymore, it's premium entertainment with World Cup branding. FIFA's mastered the formula: scarce supply, global demand, and zero discounts. So the bottom line, the beautiful game is still beautiful, just increasingly unaffordable. India's FX reserves are back on the climb, up $22.7 billion in FY26. Solid but not spectacular. The real story: gold quietly stealing the show. While foreign currency assets dipped, gold reserves surged by nearly $36 billion. That's not diversification, it's a subtle shift in strategy. When central banks start hugging gold, it usually means one thing: trust in fiat isn't exactly soaring. This is RBI playing defense, hedging volatility, geopolitics, and a wobbly dollar cycle. So yes, reserves are rising, but the composition is telling you what really keeps policymakers up at night.